Like my sweatshirt, ask me about real estate. Let's talk about the federal fund rate. What does the federal fund rate mean? You may have heard me in the past. I'm going to keep it short and sweet. It is what it costs banks to borrow money against other banks. Now, in many cases in the past, we have seen that when the Federal Reserve does cut the federal fund rate, mortgage rates typically follow. Not always. In most cases, they follow the bond market. But we have seen that mortgage rates and the federal fund rate, there's been some correlation in the past. Now, earlier this year, first quarter, I believe, maybe beginning of second quarter, there many market analysis experts, many professionals in this space were calling for 7 rate cuts. I was never on that train. I've had many conversations with other realtors, lenders, investors. I was never on that train. And the reason being, well, because we did not want to reignite inflation. And this year has shown us that, well, interest rates matter. Even late third quarter, early fourth quarter of 2024, there was some pullback in the mortgage interest rates. And we saw demand pick up, right? And when I say we, I'm talking about mortgage applications as a whole in the United States increased. Okay, they increased. That's just a fact. They did. Mortgage applications went up. The second, there seemed to be positive news about rates coming down. There seemed to be positive news of where we were as the economy as a whole. However, with all that being said, now there's been clear indication from the Federal Reserve that it's going to be data dependent on whether or not they're going to continue to cut the federal fund rate. And what does that mean? As you saw in my last post, there's a lot of things, there's a lot of economic data that the Federal Reserve is looking at when they're making these decisions, right? They're looking at inflation. Is inflation reaccelerating, right? If mortgage interest rates come low too fast, well, what can happen? Demand picks up, right? And we'll get another real estate appreciation frenzy. And we don't want to see that. We just don't want to see that, right? I know as homeowners, we think, yes, our homes are appreciating at rapid levels. I understand that. That's great. But for the sake of the health of real estate, we want to see a more modest appreciation. We don't want to see another rapid appreciation that we've seen during the pandemic. So they're going to be keeping a close eye on inflation, right? They're going to be keeping a close eye on GDP growth. Is the economy growing? They're going to be looking at our financial ability of the consumer, right? Consumer confidence, right? Credit worthiness. Where are we at with our credit? Are we seeing a lot more credit card delinquencies, which we have, right? We have seen credit card delinquencies pick up at all-time highs, right? We're going to be looking at retail sales to see if, going back to what I just mentioned, consumer confidence. Are people out there buying, right? Are we buying? Are we buying at Target, or are we buying at Walmart? Walmart has been producing, have been doing well, from my understanding, I believe, last time I checked. So are people downsizing, right? Are they, what's going on? And this is economic data that can give us somewhat of an indication of what the Federal Reserve may want to do. It's tricky because they don't want to cut rates too low too fast and reaccelerate inflation, right? But they don't want to keep rates too high where the economy starts to crack. So it's a fine line that they're walking. So I do think that this year there's going to be maybe 1 or 2 cuts. Unless I reserve the right to change my opinion, like we all do. Okay, this year I do think we'll see rates stay where they're at, around 6%. I'm on that train. I do think that if the economy starts to crack, we will see the Federal Reserve pivot and rates may start to come down because they do not want to break the economy. Now, I still think the economy is in very good shape. If for those that follow the stock market, that is a true indicator as well to see where we are as a nation, and the stock market is still healthy, right? And I do believe there's still growth that can occur in the stock market. Now, why is that? Well, let's take a look at savings accounts. The consumers are still, even though we're seeing reductions in high yield savings account, there was a lot of money printed in 2020. Okay, I'm sure many of you know this. There was a lot of stimulation in the economy, a lot of money printing. There's a lot more money in the economy that has printed. I wish I had the data and the statistics here in front of me. I don't. Do your due diligence, right? Don't take me for my word. Do your research. But there was a lot of money printing during the pandemic, and the people for the very first time are actually seeing a pretty nice return by having your cash in a high yield savings account. That wasn't the case for a very long time. For a long time, you're getting 1%, 1.5% having your cash in a high yield savings account. But for the very first time during the pandemic, when rates started to rise, the good thing about the Federal Fund Reserve raising the federal fund rate is that, well, yes, credit card rates, mortgage rates are higher, but so is your high yield savings account. So people were making some money having your cash sitting in a high yield savings account in the bank, right? For the very first time. Now, what happens when the federal fund rate starts to cut? Well, when the Federal Reserve starts to cut the federal fund rate, people aren't going to make this kind of money from their high yield savings account. So they're going to be looking to park their money elsewhere. Where are they going to be looking at? I think they're going to be looking at the stock market. They're going to be looking at real estate, right? Because when the Federal Reserve starts to cut the federal fund rate, that means you're not profiting as much from your high yield savings account either. So I do think there's still growth for the economy in 2025. I think it'll be slow growth. I think it'll be data dependent. I think there is a lot of uncertainty, right? There's a lot of things we have to keep an eye out for. One of them being, well, hey, we got a new president, right? He's talking about tariffs. How will this affect the economy, right? There's still a lot of uncertainty in the economy. Nvidia, they play a big role in the S&P 500 success, right? So we're going to keep an eye out on their earnings as well. These are all things that matter when it comes to the health of the economy. So I'm paying attention closely. I don't think there'll be much movement this year when it comes to mortgage interest rates, right? So if you are comfortable around the 6% range, it could be a very good time for you to start looking to lock up opportunities, because there is less demand around this time, right? And yeah, put yourself in a position to win. That's just really all you can do. And yeah, but my call is I think we'll stay in the sixes, 6.5. Maybe towards fourth quarter we'll get down to the 5/8. You know, if we seem to be getting the economy seems to be getting under control, and we're getting inflation under control. So that's my take. That's where I think interest rates are going. I think we're going to see not too much action, not too much movement on the upside or downside. I think we're going to be relatively flat for 2025, but we will see. I do think maybe if we're lucky, we'll get to the 5.8, 5.7. I'm hopeful we will. But I plan to start making more videos on YouTube. You know, this is not scripted. This is me just talking, sharing my thoughts. Since the pandemic, I've really been diving into just data, and I've really got into it. So I want to continue to make more videos. I want to be more active on YouTube. But yep, that's where I believe 2025 is heading. Peace and blessings.